Hello and welcome to the Mutual Fund Show. I'm Neeraj Chan. Over the next 20 odd minutes, we'll talk with CRISIL Research, the Director of Fund Research at CRISIL, about what are the key takeaways according to him and according to CRISIL of 2021, and some very interesting developments that have happened through the year, which led to some statistics on which we will question our guest today, Piyush Gupta, that is. Interestingly, as I read the note, I realized that liquid funds have indeed lost some sheen. ETFs have become the largest MF category, and floating rate and target maturity funds have gained a lot of traction. Now, some of you might be wondering why this is the case, and are these applicable for your portfolios as well? Well, I think we'll get the answers during the course of the show. Let's get in Piyush Gupta from CRISIL to talk about these very developments. He's, of course, Director of Fund Research at CRISIL. Piyush, great having you. Thanks for joining in. Hope all is safe.
Thank you, Neeraj. Good to join.
Yeah, thanks. Great having you. Piyush, interesting note and a short one at that too. But give us a key takeaway of what was the key development according to you, which you would have penciled in the note as well.
Yeah, so for mutual fund industry, if you look at last calendar year, Jan to December, this was a period when the industry witnessed highest growth in terms of assets under management. This was the asset gain was close to 6.7 lakh crores. If you look at previous year highs, it was in 2017, which was around 4.8, and for again in 2020, which was again a good year for the industry, the gains were about 4.5 lakh crores. If you were to look at within the mutual fund segments or different categories which were there, the trends were different, especially for the last 2 years. While the inflows were similar, about 1.81 lakh crore for the overall industry, the gains were largely driven by equity mutual funds in 2021, while in 2020 it was largely driven by debt mutual funds. It was also for 2020, I would say it was on the back of this significant decline in AUM that we saw in March 2020 at the onset of COVID, but still the category managed to regain the outflows, and was a key driver for the growth in 2020. But in 2021, it is largely driven by equity for the overall mutual fund industry.
Yes, indeed, and not surprising really, the way not only the SIP numbers have looked like, but also the gains in the portfolios, I presume, for most AMCs, if not all.
Yes.
Okay, so three things caught my eye, Piyush, and I would want you to dwell upon each of these individually. First, ETFs becoming the largest mutual fund category. Now, for the last 3 or 4 years that we've been doing the mutual fund show, there's been a lot of sporadic chatter about how ETFs, passive investing, all will come to India, but maybe will come with a bit of a lag, and ETFs still have some time to go. And voila, we have in 2021 ETFs becoming the largest category. Tell us a bit about what are the key learnings out of this development happening, and why do you think this happened in the first place?
Yeah, so ETF again, it's a category which has seen significant amount of inflows. If you were to look at investor segments, large portion of that money is coming in from the institutional investors. Largest being the provident funds, including EPFO. All of these provident funds have a mandate to invest at least or up to 15% of their total investment during the year into equity, and a lot of these provident funds have opted exchange traded fund as an avenue to participate in the equity markets. So that is one big factor. If you see, it's like an SIP for the entire mutual fund industry. All the contribution that comes from the employees in these provident funds, by default, 5 to 15% of that corpus typically goes into equity on a month-on-month basis. So that's one big factor which is driving the growth of ETFs in the recent period. The second factor, if you were to move out of the institutional investor, is also the fact that the performance of actively managed large cap funds have seen a decline. We did one study some time back where we found that the average alpha for actively managed large cap funds has been declining consistently. And this is not just a recent period, but over the last 3 years, we have seen that even the long-term performance of actively managed large cap funds is lower than the benchmark, which has meant that a lot of investors who want to participate in the large cap category are essentially opting for ETFs to take exposure to the large cap segment.
And Piyush, I reckon that is probably natural simply because of the rules and regulations that SEBI has put in with regards to stock selection for the large cap funds, and the fact that the cost structures of an ETF would be much better than an actively managed large cap fund any which ways.
Yes. So one, of course, is the expense ratio, which is very different for ETF compared to actively managed funds. And also, you're right. Even the boundaries under which the large cap funds have to be managed, that also creates some bit of limitation. For instance, they need to invest at least 80% into those large cap stocks, which again the universe is limited to those 100 stocks. So ability to pick up winner within that universe of 100 stocks also gets limited.
What I was particularly interested in, what Piyush was the finding that liquid funds have lost their sheen, and please elaborate a bit on this. Simply because a lot of viewers would, by virtue of having learned this over the years, steadfastly believe that instead of putting my money into a short-term deposit or something,
Yes.
let me just put it in a liquid fund. I'll get, when my time duration is short but uncertain, because that gives me better returns than what the bank return would be. Now, that might well be true, but still, liquid funds have lost their sheen. Why has this happened?
Yeah. So again, liquid fund, it was a major category. Still is a big category if you were to see it today. Large part of that money would be dominated by, again, institutional investors. So that uh, so even though while retail investors would be putting some bit of money, large portion of that AUM is still dominated by institutional investors. There are few things that have, or few updates that have happened with respect to the category, which has led to the I would say flattish AUM that we have seen in the last 2 years. One is what we have seen is in the last 2 years, the interest rates have been at a lower level. If you look at 2020 and 2021, the short-term interest rates have been extremely low, which has meant that even the returns from the liquid fund category has seen a decline. If you were to look at period prior to say maybe 2020, say year 2019, the average return would turn out to be about 6% or so. If you look at last couple of years, the returns have averaged around 3.5%. So that is one factor which has played out. Second is there are other structural changes which have happened. For instance, earlier liquid funds were allowed to amortize their returns from the underlying holdings, which meant that the volatility in the performance was limited in liquid funds. Uh, uh, Post 2020, through multiple in the phased manner, what has happened is the entire portfolio of liquid funds are now mark to market, which means that change in the interest rate has a bearing on the pricing of underlying securities, which has also meant that the portfolio managers have reduced their maturity compared to say 2019 or 2018 earlier period. So that is one factor. Second factor is there is also introduction of exit load, 7-day exit load, which has come in, which means that anyone who's exiting a liquid fund within 7 days, they have to pay an exit load, which means that at times the returns may not be sufficient enough even to cover for that exit load. Uh, and anyone, especially any institutional investor who's possibly parking money for period less than 7 days, they have now started looking at alternate option in the form of overnight fund, because the returns between overnight fund and liquid funds are also not very different. So if you were to do a cost benefit analysis, I might as well put money in overnight fund if my horizon is less than 7 days compared to a liquid fund. So that's the second one. Third is decline in performance is also because of the fact that there is a requirement for liquid funds to have at least 20% of their portfolio into cash and equivalent. which means short-term instruments like reverse repo or maybe T-bills and so on and so forth. So which means that the return generation capability is further constrained, given the fact that they have to construct a portfolio in this manner. So these are some of the factors I believe have played out for liquid funds in terms of, I would say, slight decline in traction in terms of the category that we see.
Piyush, maybe you already referred to it, but I have missed it. I believe your note also says that the liquid fund categories assets are now treated at par with other debt MFs as mark to market rather than the
Yes.
amortization rule. Can you just briefly talk about it?
Yes. So what happened earlier was, if a liquid fund is holding a 30-day security or a 45-day security, the yield to maturity on that security, say, let's assume 6% for the example's sake, then that 6% is amortized every day. So it's a accrual of 6% till maturity that one would get. Now, which means that irrespective of change in the interest rate, the price of the securities will continue to accrue during this period of time, which means that the interest rate risk on liquid funds was even lower, even though while the short-term instruments anyway have a lower interest rate risk, with this accrual it is even lower. Now, in the recent period, what has happened is the securities are required to be mark to market. For instance, if the interest rate go up from today to tomorrow, next day if the interest rate go up, then the price of the underlying security will go down. The degree is anyway lower because it's a short-term instrument, but still there is a mark to market component which is coming. Now, if you were to look at the average maturity of liquid funds also, prior to this requirement, the average maturity of the liquid funds were 45 days, 50 days, and so on and so forth. Now, in order to reduce the volatility, even the maturity of this category within the portfolio has also come down significantly. So this valuation also has played a role, both in terms of performance as well as the way the portfolios are being constructed.
Okay. So investors are choosing, at least in the short-term side, the overnight funds as a category as opposed to liquid funds. And thanks for
especially for the period less than 7 days.
Less than 7 days.
Yeah.
Perfect. Yeah. Okay. The last piece that I wanted to talk to you about, Piyush, was your findings again that floating rate and target maturity funds have gained traction. Can you please tell us what are these funds? What kind of investors are they suited for? And why is it that they have gained traction?
Yeah. So floating rate fund, by definition, even the SEBI definition says that you need to invest at least 65% of the portfolio into floating rate instruments. Now, floating rate instruments are different from conventional fixed income securities. In a conventional fixed income security, what you have is a fixed coupon, and if the interest rate go up, the price of the security goes down, and if the interest rates go down, vice versa. Now, in case of a floating rate instrument, the coupon which is there, it gets reset on a reset date. So, for instance, if the interest rates were to go up, then the coupon received or accrued also goes up during that period, which means that floating rate instrument in a way becomes a hedge against interest rate movement. What we have seen, especially in the last 1 year or 6 months or so, is the interest rates have, there has been expectation that the interest rates are likely to go up. In fact, in the last quarter, we have seen a rise in the interest rate, which has meant that the investors, in order to hedge their exposure to interest rate, they have started investing into these categories.
Okay, and again, and this risk of repeating, but target maturity funds, because I've also heard a lot of guests who've come on the show all through December and some part of January talk about how investors would do well to actually get into target maturity funds because with the intention of with the idea of where is it that they would want at what time do you want, what did they want their capital to come in as well. Can you talk a bit about target maturity funds, why are they so popular, and
So target maturity fund, if you were to look at as a category, this is a category where the fund first identifies an index which they would want to replicate as part of portfolio. Now, if you look at a lot of the target maturity funds which have come in, they have underlying either in the form of government security, SDLs, or for that matter, corporate bond, PSU corporate bonds. If you were to look at the underlying, it is slightly on the safer side, right? From the credit quality perspective, the credit quality is superior. Which in the current market condition is whatever we have seen in the last couple of years. There is also an expectation from the investor to have a more secure portfolio to avoid any kind of any event in terms of downgrade or default. So that is one big factor. Second is in an actively managed funds, what you will typically, you can have a situation whereby while the portfolio could be of certain credit quality, but it can change over a period of time, where there is also a discretion that the fund manager may exercise when it comes to constructing a portfolio. In case of a target maturity fund, the portfolios are essentially driven by the underlying index, and these underlying indices are largely have a defined mandate. It could be they would be having underlying securities in the form of GSEC, SDLs, or corporate bond PSU, which means that you will have very less chances of having any kind of a style drift in the portfolio. So that is one aspect. Second is, of course, interest rate scenario. We have seen that the interest rates are inching upward. There's also an expectation that further the interest rates can go up. And during that scenario, if you were to enter into a target maturity fund, which follows a roll down strategy, which means that the duration of the portfolio will be at a certain level at a given point in time. And as it approaches the maturity will become close to zero, which means that when the investor is entering into the portfolio at a given point in time, and if the interest rates are at a high level, he's sort of able to lock in that interest rate which is prevailing at that point in time. Also, these funds are also open-ended, so which means that 3 years down the line, if he sees that the interest rates have anyway the duration has come down, so there is mark-to-market gain that would have got realized in the portfolio, and at that time he also has an option to exit by booking those mark-to-market gain. And with the 3-year taxation, it makes all the more sense to sort of participate in the target maturity funds.
Got it. Piyush, this was nice to understand some key statistics that came out of 2021, which you've of course captured very well in your note, but through this show have told me and our viewers as well. And thank you so much for that. And look forward to have you more often on the show. Thank you for joining the show today.
Thank you so much. Thank you so much.
And viewers, thanks for